There's a major focus on the US and UK and financial markets this week because of some very important economic data releases starting today. We had the US inflation release just ahead of the open on Wall Street, and earlier this morning we had the UK jobs report. We'll start with the US, where the inflation data was very, very positive. Now we're talking small improvements in the data here and small misses compared to expectations, but it's really important for a couple of reasons. One is, had the data gone the other way, then that could have painted the picture of stubborn inflation appearing in US data for a few months that could suggest we need more interest rate hikes, and the interest rates, as the Fed has warned, could stay higher for longer. But today's data appears to have gone against that. And by that, I mean, we saw a miss on the headline CPI yearly figure from 3.7 was expected 3.3, was actually 3.2. The core annual figure was expected to remain at 4.1. That was 4. So clearly, two important misses there as far as the economy and also the Federal Reserve is concerned too, even if they are just 0.1 readings. But actually, the important points here came on the monthly data, because that's where we get a sense of the near-term trends, and they were really positive too. We saw last month it was 0.4%, so we saw a big spike, and that was already expected to fall to 0.1% in October, but instead it was completely flat, so undershot there. The more important one is the monthly core readings, and that's why I'm coming to that last, because we'd seen 2 consecutive months of 0.3%, having bounced back from 2 consecutive months of 0.2%. So while the overall trend was still declining, if we'd have seen another month of 0.3% or even higher, 0.4%, then that would have suggested that a stubborn trend had emerged that the Fed would find really concerning going into that December meeting. But instead, it printed at 0.2. That maintains the prior trend that we were seeing in the monthly data and suggests that the 2.3% print could just be a bump in the road. Now, we do have another inflation report due the day before the Fed's next interest rate decision, which is, of course, going to be critical. But this puts us in a much more positive position than we could have otherwise been had this not been such a promising report. The other economic report today, as I've alluded to, was the UK jobs data. Now, again, this data, on the face of it, doesn't look particularly great. The unemployment rate remained at 4.2%, but that is still well off the lows at 3.5%, so we can't ignore that fact. The employment change was also minus 207,000. The claimant count changed 17,800. But it was the average hourly earnings that was always going to be the crucial point here. And the reason why I say that is because tomorrow we're expecting a substantial drop in the inflation number. And when you're watching this, you may even know if that has ultimately occurred. But market expectations currently are for a decline from 6.7% to around 4.7, 4.8%. So that's a substantial drop. But that's all well and good for the Bank of England. But if wages are not declining from these very high levels, then they are not going to be comfortable to even consider cutting interest rates at any point, and may still be slightly leaning towards another interest rate hike in order to create that additional coolness in the labour market required to get wage growth back to something consistent with 2% inflation. And on the face of it, it doesn't look like we've received that today. 7.9%, including bonus, 7.7%, excluding bonuses. Both are moving in the right direction from the previous readings, but not significantly so. However, again, the monthly data here is going to be crucial for central banks. That gives us a better indication of near-term trends. And while you can't see it on the calendar, the monthly data for the last 3 months has been much cooler. So the first 8 months of the year were 7 or 8 months of the year were very strong levels of inflation as far as wages are concerned. But the last 3 months have been much, much cooler, actually consistent with wage growth on an annual basis of maybe closer to 3%. So again, that's much more consistent with the Bank of England's inflation target of 2%. So while the headline numbers here don't look too fantastic, the underlying figures and the monthly figures in particular from both the US and the UK are starting to look much more promising. And that's why we have now seen, particularly in the US, markets are no longer pricing in any more rate hikes from the central bank. Prior to today's recording, we'd seen that markets were pricing in around a 25% chance of an interest rate hike from the Federal Reserve at either the December meeting or the January meeting. After the report, it's closer to 0%, maybe 1%. So markets are clearly convinced that this was the final nail in the coffin of the tightening cycle, and that the next move is going to be to the downside. And with that in mind, let's take a look at a chart. And the obvious chart to throw up here is the pound versus the US dollar. And what I really like about this chart now is, from a technical basis, it's looking quite promising. We had the declining trend over the course of the period from July, so the summer, through to the start of October. And then we had a period of consolidation. You can see that from the triangle that you can see on that chart there. That doesn't necessarily give you any directional bias. From a technical perspective, if you see a rising wedge formation, that potentially indicates a slightly bearish bias. But with a triangle like this, it doesn't necessarily give you that. So what you're waiting for is the breakout to give you an indication as to where the market bias is potentially currently lying. And as you can see, we saw a breakout to the upside. That was just earlier this month. So that suggested the market had turned a little bit more bullish on this currency pair. We rallied up towards those previous highs that you can see at prior area of support and resistance around this point here. But importantly, we then corrected lower. And that is where these levels do start to look more interesting. I'm going to scroll in here because where it then ran into support is the top of that triangle formation that we had formed previously, which also coincided with the 61.8% Fibonacci retracement level. So that was around 122. And we were already starting to rotate higher. And why that's important is because that suggests that the market potentially had a slight bullish bias going into these important reports. But ultimately, these reports needed to follow through if we were going to see it build upon that. And that's exactly what we've now seen. The pair had already trended higher, but it's really built on that because we've been on the back of data, particularly the US data, that's seen a softening of the US dollar, and the pound against the dollar has rallied on higher. Not only is it rallied higher, it's gone beyond the previous highs that we saw earlier this month on the 6th of November. And all of a sudden, we've gone from a pattern that was very bearish to one that was quite neutral to a potential bullish breakout. And now the fact that we've rotated off a key fib level off the top of the triangle and broken to a new high, which means the pair is now trading at its highest levels in a couple of months, that is now could be argued to be a bullish setup. Now, obviously, there's no guarantees in trading. There's no guarantees in technical analysis, and the fundamentals can change. We've got another batch of economic data to come tomorrow, the UK inflation report. So that's going to be really important, and that could shift things again. But this is now looking like a more bullish setup, especially when you consider the trend that we had since that summer period. I still think there's going to be an element of caution about this, but ultimately we are seeing a setup here that has seen a consolidation from following a downtrend, a breakout higher, a rotation of a key fib level, and a move towards a new high from there. So I think this is looking quite healthy at this point in time, but ultimately the inflation report tomorrow from the UK could either change that or further reaffirm that position.